All right, yo, I'm doing this video for straddles, just for y'all to be aware of how to use that strategy. Very easy, very easy. It's not something that's gonna take a lot of time and effort to come up with. All right, the only reason why you would want to use this strategy is if you're in a situation where the stock is very volatile, and let's say we got an earnings call coming up and you don't know what direction it's going in. So you did all your fundamental analysis, your technical analysis, and everything, and you got everything you need, but you still aren't convinced about what direction it's going to go. So instead of you just sitting out and waiting, you still want to get in position, but you want to tackle both sides of the market so that way you don't miss the move. So normally when I'm getting into these type of positions, I want the volatility to be extremely high, usually around 80% or higher. Anything below that doesn't really tell me that I'm going to get a big move or not. Even though the move might happen, it might still be a big move, but the implied volatility is almost telling. It's like giving you a heads up that you know what it could be. All right, so high volatility, not knowing which direction it's going to go. What you want to do is you want to probably scale down to a smaller time frame because you don't want to stay in both contracts for long. So you're going to have two contracts, one for a put, one for a call, same expiration date, same strike price. So you get to sit there and watch and see which direction the market is going to go. Once the market decides which direction it's going to go, you can then go back and cancel out the contract that is in the negative. So one's going to be in a positive, one's going to be in a negative. You don't want to keep both. A lot of people keep both and they just close the whole strategy together, and then the loss will cancel out and you'll have that profit. But when I do it, I like to get out of the one that's losing and then ride the one that's winning all the way out. So if you go down to a smaller time frame, and let's say, for instance, we're using like the daily pivots or even the weekly pivots, trying to figure out where your target is going to be. You need to have a target for both sides. All right, so they have to make sense. So in this case, let's say for instance you wanted to have one target at the support level and then the other target at a resistance level, maybe a moving average or a resistance for the pivot. You already know what target you at. Now you just have to figure out exactly what direction it's going to go. If you're in position before the earnings call will give you that direction. If you look at the daily pivot, you see in this case the market opened up and there was a gap down, right? So it was a gap down, but we on the hour chart. So it gapped down at 8 o'clock. The market opened, and then at a nine o'clock candle, it gave you a bullish engulfing candle and engulfed all that gap, and then it went up for the rest of the day. So once you get in and you see the market open, and after the earnings results come out and it moves, don't close the contract right away. You need to give it some time so that you could tell which way it's actually going, because it might start out one way and then turn around and go the other way, and it might be so much momentum going in the opposite direction that it continues to go in that direction for the rest of the day. So this example right here is what I'm talking about. It gapped down, and then the next hour opened up and it engulfed all of that loss, and then it carried over for the rest of the day. So in this case, if I had a straddle and I started out losing on one side, I would have waited to see what would happen for the rest of the day, or at least the next hour, and then with that next hour turned bullish, I probably would have closed the put and then rolled the call the rest of the way out, and then I would have collected all that profit. All right. So that's the psychology and strategy behind it on the technical side. Now, if you go to the actual options chain, you wanna again, it's very easy. All right, all you're doing is buying a call and a put at the same strike price at the same expiration date. All right, so if I'm in the money call right here, and then I go over to a put and I get another out of the money put, you see long straddle. All right, you got both sides of the market, and you got the options profit calculator on Robinhood to let you know what it looked like. Then you can go to optionprofitcalculator.com if you don't have this capability on your Robinhood, and just click on The straddle option. Hold on one second. So if we go to optionprofitcalculator.com, you can see on the top it says straddle right here. So you just click on straddle, and then you just input everything like you normally do, and then you'll be able to see the whole calculation. All right. But if you're in Robinhood, you'll see it look like this. So each side, you got however long it takes for you to break even at expiration. So like I said, a lot of people keep the contract open, and then close it out altogether, and then the loss will cancel out, and you'll have that gain. But I don't like doing it like that. I just want to be in position, so that way I know. Plus, if you end early, you know that your premium is going to be lower when before the actions take place. All right, so you want to get that good premium and just be in position, and then when it start moving, you already got it. So then you can just sell the one that ain't winning and ride it all the way out, and that's pretty much it. So when you want to exit the situation, you basically just do what you always do. You close out the one by doing the opposite of what you did to get in. So if I wanted to get back into a long position, all I would do is come back and sell the put. I'll sell the put, close this one out, and then I'd be stuck with the call, and then I'll ride the call out for that profit. All right, and that's pretty much it. There ain't nothing else to it. It seems like a complex strategy, but when you know what we know, it's really, really easy. All right, and it's easy. That's how you execute it. All right. If you got any questions, go ahead and let me know.